But it gives me great pleasure in introducing Dr. Arvind Rajan, CFA. Dr. Rajan is a managing director of PGIM Fixed Income, which is part of Prudential Financial. He's got more than 25 years of experience in the fixed income world. He's worked in the Bell Labs before that. He's a graduate from IIT Madras, and he's got an MS and PhD from Northwestern University. Please join me in welcoming Dr. Arvind Rajan.
It's a pleasure, it's an absolute pleasure to be here for CFA's first fixed income conference. And I hope it's not just the inaugural one, but one of the first of many such events. For me, there's another first, which is a personal one. Ever since I left India 38 years ago, after graduating from IIT Madras, my travels have taken me to the financial world, and I've in the last quarter century visited more than 35 countries professionally. But rarely have I come to India. I've come maybe 4 or 5 times and never to Chennai. So it seems especially fitting, that this kind of completion of a circle, my coming back to my hometown, should coincide, with the completion of another cycle, which is my own professional career. So I am actually retiring this month, and not necessarily from finance, but from Prudential, and setting out on my own personal journey. So for all these reasons, it's fantastic to be here. Now, I'm going to touch on both global and emerging market themes in today's discussion. And it's always better to begin with the bottom line so that you know what to expect. So in reviewing the global economy, I would say that there are 2 major conclusions that I have come to. The first of these is that the base case for global economic expansion, cyclically speaking, over the next 6 or 12 months, is positive but anemic. So I think that one should not be discouraged by what has been globally a significant downturn, and in India as well, a significant downturn in the economy. I think it's likely to pick up over the next 6 to 9 months. The other lesson, though, is a longer term one, and it has to do with global yields. And I think that there is a big question in everybody's mind after almost 30 years of rallying. Will interest rates now remain low, or will there be a sharp V-shaped turn back? And I will try to convince you today that I believe in the former hypothesis. I think that we are going to bounce along in the much lower range that we have today. And there are some really powerful secular forces that don't go away so easily, that are actually driving that phenomenon, and try and explain what they are and how they operate. Although interest rates may remain low, it doesn't mean that we're going to have an easy ride. Because one thing that you notice in low interest rate environments is that there is a very high propensity for markets to be skittish and to respond very violently to news. So I think you're going to also see a lot of volatility and confusion in the risk markets over the coming years, because the preservation of that low interest rate environment has now become crucial to maintaining the global macroeconomic order. So with that as preamble, let me get going. I need my clicker that I forgot. So I'm going to start off and spend approximately 30 minutes or so on the global economic market review that I just mentioned here. And then I'm going to spend the last 10 minutes or so giving you a whirlwind tour of where India fits within the context of emerging market debt as a whole. And I think that'll give you a perspective of where, what we can conclude about the Indian bond market vis-a-vis its competitors around the world, which now includes something like 75 countries. So let's dive in here. So the first point that I want to make is that the pretty dismaying drop in both global GDP growth on the left-hand side and PMIs on the right-hand side appears to be bottoming out. You can see that we've had a pretty significant drawdown here during the course of late 2018 through late 2019 in economic output. And on the right, you can see that it has been significantly driven by manufacturing. Services have been actually less weak, although they have also dropped off recently. But the good news is that in the last 4 to 8 weeks, and these slides are a few days old, you can actually see the turn in global numbers. So what we think here is that it's likely that the global economy will have a cyclical bounce back sometime in the next quarter or two. And the reasons for that have to do with some tailwinds. So we have had significant easing by the Federal Reserve. We have also had a somewhat accommodative stance from central banks around the world. China has been stimulating its economy significantly, and China is a huge part of the global growth story. So for all these reasons, we are starting to see results. Now that's monetary policy. On the fiscal side, most countries, with the exception of Europe, led by Germany, are pursuing pretty loose fiscal policy. And next year will be no exception. So we're going to see additional fiscal tailwinds over the course of next year. If you combine that with the natural bottoming of sentiment that might come from a trade agreement, which is part of my base case, I think you should expect to see global economic growth pick up in the first half of next year. One of the bad stories within the context of anemic growth over the last 10 years has been trade. So we all know that in line with Reinhardt and Rogoff's thesis that this time is different, and if you haven't read the book, it's fantastic and really entertaining reading. I really recommend it to you. That the global economic recovery that came after the big crash of 2008-2009 was quite anemic. And one part of that story was the fall off in export volumes. Now, a big part of the culprit here was lower imports from Europe, because Europe had a major crisis after the global financial crisis, and in between 2011 and 2015, they basically were flat on the backs. So the amount of imports coming out of China to Europe was a big chunk of the drop-off here. But you can see that the economy globally did grow over the course of the last 10 years, and normally when that would happen, you might see exports contributing more strongly than the economy as a whole. So for example, between 2000 and 2010, you actually had 5 to 10% growth in exports. But you can see that the average here for the last 5 or 6 years has been 2 to 3%. So in fact, exports, global exports have been a very small part of the growth story, and I think that's going to remain the case going forward as well. Partly because China is fading, partly because there's a lot of protectionism around the world, and partly because the overall usage of trade in the context of how policymakers are stimulating the economy has shrunk somewhat. And instead, attention has turned more towards domestic considerations. Now, this is both a bit of bad news and also an opportunity for countries like India. I think that as tariffs in China are unlikely to be fully rolled back in the context of an agreement, India actually has the opportunity to step into the breach. And I think there are a variety of measures that one can take, and particularly in manufacturing, given the labor cost advantages, India may have a role to play. The other piece of news regarding the global economy, which is actually good news, is global inflation. You can see that it has been really steady between 2 and 3% in recent years on the right-hand side of the page. And that is one of the enablers for fixed income yields to stay low. Now, let's talk briefly about the trade war. Now, the Trump administration clearly views China as a strategic competitor. So this particular trade dispute that is going on is not likely to be a tactical one or a short-lived one. So even though we probably would get a trade agreement, it's not going to be one that ends the story. I think it's just the first chapter of a Shakespearean play. So I think you should expect year after year after year of skirmishes and new issues with respect to that. However, the good news near term is that both President Trump and President Xi need an agreement. President Trump needs the agreement because he's got an election coming up and he needs to campaign for that. And President Xi is having trouble stimulating the Chinese economy. He really needs, and the trade was really hurt. So he really needs this agreement. So despite the Twitter war that's going on and the public relations dispute, which is, by the way, inevitable just before you come to an agreement, I think there's a pretty good base case, and I never say anything is 100%, but probably 2/3 to 70% chance that you'll see some type of trade dealing within the next 2 to 3 months. Now, trade war has really hurt the financial markets. In addition to a variety of other factors, trade war has tightened up global financial conditions and increased the volatility of stock markets. Now, that hasn't prevented the S&P 500 from registering new high multiples, and it's been the leader within the global equity world. We'll talk a bit more about that when we get to the fixed income side. I'm not an equities guy, but I have a view about how fixed income spills over into higher equity valuations. Now, central banks, which are really key, of course, to how we think about global fixed income markets, have turned around, largely led by the Fed, in terms of asset purchases and overall levels of assets. So the Fed, as you may all know, has been injecting liquidity back in a quantitative way into the markets. And the reason for that was that when they withdrew some of that balance sheet, they got to the point where things really started to not work. So we had failed auctions, and that you really can't have that in the world's most liquid front-end bond market, and T-bill market. So essentially, this addition of liquidity is meant to ease those conditions. It's not meant explicitly to be a quantitative easing to stimulate the economy. So the purpose is different, but the mechanisms are very similar. So the fact that additional injection of liquidity is taking place there, and the fact that the ECB is kind of on hold and may use more of its firepower to buy assets if Europe remains flat on its back, as well as the fact that emerging market central banks are likely to indulge in a bit of competitive devaluation by buying dollars. All of these are likely to be supportive, for dollar assets, and in particular fixed income assets in the coming years. So let me get to that point, the support that exists for fixed income assets. I just mentioned one technical driver. I will end with another technical driver, but I want to spend a good chunk of the time that remains to me to talk about the fundamental drivers behind low yields. Now, the first and perhaps most paradoxical idea is that high levels of debt actually lead to low yields. Just think about that for a second. High levels of debt lead to low yields. You'd think, how can that be? If you supply more of something, its price should drop. When prices of bonds drop, the interest rates associated with them go up, not down. So why would a high level of debt actually lead to lower levels of bond yields? Now, the reason is that bond yields are not an isolated commodity. They are actually intimately connected to the way that the world works. And when you have high levels of debt, that is a big drag on growth. And it's a big drag on inflation. And these two factors together pull down the yields associated with equilibrium. Now, there is another aspect to this, which is that when you get to a certain level of debt, everybody except the investor who wants higher yields is pushing to keep those interest rates low, because the economy becomes very sensitive to increases in interest rates, and large chunks of the economy become dependent upon and hooked upon low interest rates. So policymakers then join this unholy mix of factors that push down interest rates and keep them down. And you can see that happening in Europe and in Japan, where both the ECB as well as the Japanese government, the latter much more explicitly, have targeted the back end of curves and pulled them down. So that's one big factor. And the second is aging demographics. So this is something that's not commonly talked about, but in fact, the aging population around the world is actually the cause of lower interest rates. In addition to aging, there's also the inequality increase that's occurred over the last 20 or 30 years. That's a major factor that pulls down interest rates, and I'll explain why. Globalization and technology are two other factors that have been with us for quite a while, that have been pulling down inflation, and have also therefore made it possible for risk premium on top of that inflation to stay low. There is a fair amount of confusion around China, but the decelerating economic conditions in China are a tailwind for interest rates and bond markets. And finally, tax structure changes over the last 30 years have made it imperative to keep interest rates at low level and have made the global economy much more sensitive to rises in interest rates. So let's briefly look at these factors. The first of these has to do with overall debt. On the left-hand side, a sharp rise in government debt in pretty much across the world. And then on the right-hand side, a sharp rise in private sector debt up to the crisis. And after the crisis, most of those lines flatten out. But the overall sum of these two things has continued to go up since the global financial crisis. If you go to the relationship between the debt burdens and the GDP, you notice that the world has gotten richer over the last 50 years, and as countries get richer, the level of mechanical level of non-financial debt that they tend to have in their economies increases. So, in fact, we should expect that as more and more countries climb up this curve, that you should expect to see more debt, not just in the developed world, but in the emerging world as well. Now, the actual mechanics of creating that debt on the government side are fiscal deficits. It used to be in the US that the Democrats and the Republicans were at odds on this. The Democrats wanted to spend, but the Republicans wanted to constrain debt. Now, that was the rhetoric. But if you look at the actual performance, Democratic presidents actually had a much better track record of controlling debt and creating surpluses, Bill Clinton being the most recent example. Barack Obama did not do that because there was a crash immediately after he took office. But subsequently, he did make efforts to bring the deficit back under control. Now, under Trump, we have very large deficits once again. The Republican Party has abandoned all pretense of actually wanting to be conservative fiscally, and we are likely to see 4 to 5% deficits in the US going forward. This is a microcosm of what is happening around the world. And as monetary policy becomes less and less effective, as interest rates are close to zero, you should expect to see people turn to fiscal. And Europe will probably be the very last domino to fall in this thing, because the Germans still have the ghost of the early 1920s Reichsmark devaluation in their heads. But probably most countries will in fact, cave in and use fiscal. India is not an exception. I think we're going to see some fiscal easing here over the course of the next 9 months to 12 months. And I think that it's probably appropriate to do that, because otherwise you're not going to get even the, with that easing, you're probably going to get to something that is similar to what we've seen over the last 3 to 5 years, 3 to 4% global growth. And without it, most likely, you will see more recessions, and you'll have to use the fiscal tool because the monetary tool is not working. Demographics. Now, the working age population in most countries around the world has been dropping now for some time. And the US is a bit of an exception because of immigration. But China, which is a behemoth in terms of population and size, is leading kind of the way of aging, because they just turned. And they are going to remain this is a working age population. The working age population in China is going to continue to shrink for the next 10 to 15 years. The same is true for most of the rest of the developed world. Japan was the very first to experience this, and I think it is a major cause of what you saw in Japan in terms of the deflationary impulse. Now, why is shrinking working age population associated with lower inflation and lower growth? Well, it used to be that the textbooks would tell us the opposite. They would say that when people get old, there are fewer people to work in the country, and those few people will demand higher wages, and therefore you should see wages go up and inflation go up, and therefore interest rates go up. But in fact, as both Japan and Europe have shown us, the opposite is the case. We've had aging populations accompanied by slower growth, less inflation, and lower interest rates. And this is a phenomenon that is now more widely accepted as being real and having a good fundamental reason. That fundamental reason has to do with the fact that older people, particularly when the economy also becomes more unequal, which I'll touch on in a minute, have less of a propensity to spend. And the demand side of that equation dominates, and it keeps prices under control, and it takes away the ability of wage earners to demand higher wages. This is aided by technology and automation. So in fact, we are able to carry on whatever demands exist in the economy with the same number of workers without necessarily paying them a lot. It's also aided by globalization, because if you can't satisfy the demands of an aging population with the young people who are still working in your economy, even with higher levels of automation, you can always go to Vietnam, you can go to India, you can go to China and get the cheap labor. And the supply chains are now so global and entrenched that even the protectionism that we've seen over the last few years is not sufficient to reverse that. And we have actually not seen wage pressures in the developed world despite the aging of populations and despite the shrinking of the working age. So if you wanted to have some type of empirical evidence that I'm not just talking nonsense here, I want to show you two charts put together by Nathan Sheets, my chief economist, on the connection between working age population and inflation. What you're looking at here are decade-long periods of all of the developed and emerging economies. The advanced economies are in red, the emerging economies are in blue. And on the left-hand side is the relationship between working age population growth and inflation, and on the right-hand side between working age population and interest rates. What you see in both cases is a clear, significant relationship, and we are now in the bottom left-hand corner of both these charts and heading further south and further left. Therefore, this particular piece of empirical evidence points clearly towards lower interest rates going forward, not higher. Let's look at tax structures. So 30 years ago, people have forgotten how high tax rates used to be. They were high not just in one country or two countries. The US used to have pretty high tax rates, but actually around the developed world. Since then, corporate taxes have been cut dramatically across the world. Now, what is the connection between corporate tax rates and inflation and interest rates? Sorry. The connection is that when you have high tax rates and you have the deductibility of interest income, then increases in interest rate are tolerable to corporations because most of that gets written off. In other words, on an after-tax basis, the impact of higher interest rates is diluted. But when you get tax rates down to below 50%, then interest rate increases are a very sensitive thing. They really hurt your profitability. And therefore, the global economy, the private segment of that economy, reacts very strongly to changes in interest rates and causes the economic feedback, that is, higher interest rates leading to slower growth, leading to lower interest rates, to work much better. So the feedback loop being better is connected to the tax rates having gone down. Finally, to inequality. Now, what happens when you take a lot of the wealth and concentrate it in the top 10% of the population? Well, these are people that don't spend their money. The people who would spend the money if they got it are in the bottom 75 or bottom 90%, and they are not getting it. So even though you may have decent economic growth, as we've had over the last 10 years, if that's accompanied by increases in inequality, you're not going to see the pass-through into consumption and demand that would then lead to the higher interest rates that normal theory would tell you about. So I hope that I have convinced you that these factors are, at least some of these factors are real. And what we have seen, the empirical evidence is undeniable. We've seen 30 years of dropping interest rates. We've seen it through rising and falling cycles of economic growth, lower lows and lower highs in interest rates throughout. And Japan and Europe are two examples of a really worrying phenomenon where you have negative interest rates on the front end. There's sort of blue flat lines on the bottom. And then in recent years, as low interest rates become entrenched in expectations, bondholders and risk-free asset buyers have become emboldened by the back end of the curve, the 10-year part of the curve. And that takes the yield curve that used to look like this and makes it like this. And then the whole yield curve can dip below zero, as it's happened in Europe. This is the German Bund curve. And you can see that it's not only flattened, but it's also gone below zero. In other words, to lend your money for 10 years, you have to pay someone. This is a really strange and weird concept for those of us that have grown up in a world with positive inflation and interest rates. And it has a really bad effect on the banking systems of these countries. So you can see there are two other lines here, the black and yellow lines in Japan as well as in Europe, representing the stock indexes. That's the black line, and the bank stock indexes, that's the yellow line. And the yellow line, as you can see, has underperformed the black line during this period when interest rates have been dropping. And why is that? Because banks make money by taking your deposits on the front end of the curve and lending it out on the back end. So as the yield curve slope comes down, their profitability goes down. A few years ago, the ECB did this experiment where they actually they tried to lower interest rates even further, to more negative levels. And when they tried to do that, terrible things started to happen. Banks really got weak and their stocks crashed. The ECB said, okay, enough, and they pulled interest rates back towards zero. So let me conclude here by saying that long-term interest rates are therefore likely to remain low and range-bound for the next several years. And what is also interesting here, the yellow line, which is the US, really stands out as having the highest yields in the developed world. And this has brought a flock of investors from Europe and Japan every time those yields go down. Whenever those yields go up. So at this point, we think that that level is probably 2%. So when US 10-year yields go above 2, you're going to see a flock of people coming out with $200 billion surpluses in both Europe and in Japan. There is a constant flood of money contributing to the glut of savings, looking for yield, reaching for yield, and this phenomenon is likely to continue. Let me speak very briefly on China, and then I think we should go to. I have a few minutes, so I can speak briefly about emerging markets before we go into our question and answer session. But before I do that, let me talk briefly on China and on the risks that I see to my outlook. Okay, so with respect to China, China has been engaged in an intricate and multidimensional rebalancing exercise for the last many years. Look at the many dimensions of that exercise. They're trying to rotate the economy from manufacturing to services, from exports to domestic demand, from resource intensive to green projects and clean up environmentally, reduce the leverage in the system, reduce the investment and increase the consumption components of the economy, and move from the private SOE, state-owned enterprise type style of economy to the private-driven side of the economy. This is an ambitious set of goals, and normally, if a country did those things, you would create significant employment turmoil. lots of people would need to get laid off and would get retrained, and many would never find those jobs. Well, China exists. The government has a social compact. Even China, even the Chinese government operates with the consent of the governed. And in this case, the governed demand economic growth and they demand full employment. So in order to accomplish this complicated set of goals together with the social compact, the Chinese government has been forced to increase its financing. It has financed this whole process with credit growth, which remains at 10 to 11% a year. That's the red line, even having dropped a little bit in the last couple of years. And it probably requires China to keep on doing that. Well, what's the impact of that? China's debt to GDP, even though China is still a developing economy, rivals that of the developed world. They've got 3 turns of GDP in debt. In other words, 300% of GDP as debt. And it is continuously increasing by approximately a quarter turn a year. So I think that is going to put further downward pressure on Chinese interest rates, and through Chinese interest rates on most of Asia's interest rates. The same thing is also true for the currency. So a slow devaluation of the Chinese yuan is likely, and that's likely to put downward pressure on the Asian currencies, which makes it complicated to figure out what's going to happen to the rupee, for example, and other Asian currencies, because you have to balance the fact that the rupee is one of the few high-carrying currencies in the world against the fact that it is in a competitively devaluing world where the cheapness of exports, the cheapness of labor, etc., all depend upon the currency's level. So that's the world we are looking at, a world where we expect government bond yields around developed markets to remain really low and range-bound. We do see a bunch of policy risks on the horizon, which I'll touch on in a minute. The global expansion, probably that's a good story for the next 6 to 12 months. But you can see that in a world of high debt, that growth cannot be that high. So if you look out over the next 10 years, it's hard to say that we are very optimistic and that growth will pick up compared to what we've seen over the last 10 years. For 2 reasons. One is the accumulated levels of debt and low inflation that we have, and aging populations, etc. But the second is the fact that we are starting from a much better base. 10 years ago, we were in the throes of the financial crisis, and so the accumulated growth reflects our rebounding from that. I don't think you can repeat that phenomenon unless you have another downturn, which we don't really want. So I think that central banks around the world in this context will remain easy and accommodative. However, they have limited room to do so, and therefore we'll have to go to fiscal. And fiscal remains, in my mind, the most likely tool to be used over the next 10 years. Specifically on the Fed, if they need to use a tool, they're going to go first with lower interest rates. They're at 1.5 to 1.75. We think there's a 60% chance they'll stay put next year, 30% or so chance that they will drop rates because of some contingency that I have not yet outlined here, and 10% chance perhaps that they may hike if the economy surprises to the upside. So what do we worry about? The trade war. I could be wrong about it. We might not get an agreement, and then some of what I said would not be true. Growth risks to China. I think that most of those risks are to the downside. Thirdly, European politics. Brexit is now looks like it's almost a done deal, but Brexit is only the beginning of a long journey for the UK, and many things can go wrong. Places like Italy are an ever refreshing source of both amusement and consternation for those of us that watch those markets. The global manufacturing recession, we could be wrong about the downturn being kind of at its end. If that's true, a further downturn there may have some contagion to services. And finally, you could see political tensions escalate, either in Hong Kong or in the Middle East. The latter would be particularly concerning for India because of its implication for higher petroleum prices. That said, the US has spare capacity it can bring on board through the fractionating process and the shale-based production, which is very responsive to pricing, and typically with a lag of a few months, tends to put some downward pressure on petroleum. So that is basically the picture that we have globally. Now, I'm going to take you, and I apologize for the speed, at a really breakneck pace through the world of emerging market debt, which has changed dramatically in the last 20 years. And the reason it's relevant to you as an audience is because India is in there, and it's competing with all of the other emerging markets in this sphere. First of all, the local domestic bond market curves, the hard currency corporates, and hard currency sovereigns, mostly dollars by the way, corporates and sovereigns are all trillion plus markets globally. So they are large and liquid. Secondly, on the bottom right, they have relatively high yields, 4.5 to 5.5%, and they are on average investment grade rated. This is what the indexes look like. On the right hand side, how they looked 20 years ago. On the left hand side, how they look today. And this graphic tells you how many countries have joined the emerging markets fold, providing investors with a very large number of options. This is the corresponding picture for local bond markets and for the corporate index, also getting larger and more diverse. Now, when you look at the growth picture for emerging markets, you can see that they have been exceeding developed markets growth by 3 to 4% every single year for a very, very long time, with the exception of crisis years. And that growth requires capital financing, both debt capital as well as equity capital. So it's natural to think that EM, which will in the second half of this century dominate as economic powers, is likely to require a huge amount of infrastructure and other types of financing. So you should expect them to play a more and more dominant role in global bond markets. Policy rates and inflation in many emerging markets are very, very subdued compared to what they used to be. And India is somewhat on the higher end of the spectrum, but nowhere near being dangerous. And so the dangerous ones are circled over here: Argentina, Turkey. We have blow-ups within the emerging market universe with respect to growth and inflation all the time. But as a group, they tend to have moderate policy rates and moderate inflation as opposed to really low ones in the developed world. Current accounts have really balanced out. That big imbalance between surplus countries and deficit countries has narrowed substantially in recent years, and overall is running close to flat. So in fact, overall emerging market countries may be doing a lot of transferring of capital between themselves, but it's a less extreme situation than it used to be in the past. Reserves are really comfortable in most emerging market countries, with the exception of the basket cases. And by the way, reserves are invested primarily in global bonds, in US treasuries and other risk-free assets. So that's a positive. Those reserves will probably grow as emerging markets try to devalue their currencies, either directly or surreptitiously. Contagion risk, because of the diversification and the improved rating of emerging markets, has diminished a lot less volatility than before. And the demand for emerging market assets continues unabated. A lot of that has to do with the bottom right-hand corner, where you can see yields of 5+%. This is very attractive in a world with low yields. And the performance of emerging market hard currency is actually the second best performing asset in the world over the last 20 years, next to the S&P. Just think about that for a second. Emerging market debt, not equities, is the second best performing asset after US stocks in the world. And in terms of information ratios, ratio of returns to risk, it's actually better than stocks. And then on a risk-adjusted basis, if you look at today's picture of yield versus duration, it looks really attractive. And emerging market debt is very moderately correlated with other risk assets. So it makes it a reasonable diversifier for portfolios. And in terms of currencies and stock indices, the market pressures on major emerging markets have abated in recent years. So I think that, I'm not an expert on EM equities, but I think that, we may have a better few years going forward than we've had in the past. We've had some pretty nasty years in terms of EM equity performance, and even worse years in EM currency performance relative to G10 over the last 10 years. I think that could reverse, and you could see a more balanced picture in the years to come. This tells you that more than 50% on the right-hand side of EM index is investment grade, and the spread remains relatively flat at 325 basis points. So that's a pretty good average spread for an investment grade rated group, or rather a group that is rated on average investment grade. There's quite a few countries that are single B and double B in there. So in terms of local rates, you're still getting something like 300 basis points over US rates in emerging market, domestic markets. India's 10-year in the high sixes is even more attractive than average. So Indian duration actually looks pretty good. And this is a picture of GBI's spread over the US Treasury. And that carry differential is probably going to attract people to Indian bond markets as well as emerging bond markets. So let me conclude there. That's a very quick whirlwind tour. I'm exactly out of time, so I think we will go to the question and answer session. So thank you very much for listening.
Firstly, thank you very much for that extremely thought-provoking presentation. I think for a lot of us, especially in the domestic markets here, day jobs don't really require us to think beyond what's happening in the Indian markets. Probably speak for a majority of the audience here. And therefore, I think the insights that you kind of put out and the data you put out helps us kind of think about India in the global market space, and which is particularly becoming very relevant today as domestic liquidity is significantly more constrained, and access to offshore financing for a larger segment of the market has become far more relevant. So it's particularly interesting to sort of understand what could be potential risks and opportunities in that space for the Indian markets. We have a few interesting questions from the audience. So I'm going to start with a couple of them and probably lead into a few of my own as well, if that's okay with you.
Thank you.
Sure. So one of the audience wants to know if you think the central banks over the last 10 years have achieved a soft landing. I presume this refers to what they had to do post the credit crisis particularly, and what's your view on, if they've kind of possibly taken out some of the risks that would have come out of getting out of what they had to do?
Yeah, so first of all, it's a pleasure to be here, Bama. Thank you for having me. And thank you all for coming again. And I think that in answer to your question, we have replaced one problem with another. So over the last 10 years, central banks did a brilliant job of fighting the previous war. In other words, we had a tremendous credit crisis and a deleveraging that came out of a big credit bubble that developed in the developed economies, which led to the bursting of the subprime housing market and leading to losses that people had not anticipated around the world. So those subprime bonds were held in many financial institutions in US, Europe, Asia, and no one knew the extent, just how many trillions of swaps and other types of counterparty instruments were there between those banks. The lack of that knowledge caused a confidence crisis around the world and led to the crash of 2008, 2009. There was also a massive shadow bank that had developed in the US, which overnight went bust. Solving those problems required much greater regulatory tightening, changes in regulatory conditions, legislation in both Europe and US, as well as the injection of liquidity, quantitative easing, and other measures to bring the economy up. So those are the things that the central banks did over the last 10 years. Did they succeed? Well, the results are in front of us. The world is a somewhat better place, certainly, than it was 10 years ago. We have recovered, in most cases, the economic losses that occurred, and we have come back to close to full employment in the US, pretty reasonable employment in most of Asia, but in Europe we have really not come back. But Europe's not coming back has much more to do with Europe than it has to do with the financial crisis. It has to do with the disparities between the different economies in Europe and the inability to forge a policy, a monetary policy that works for everybody, while at the same time fiscal transfers between countries in Europe are a problem. So while that remains a problem spot, you might say that the good news is that the world as a whole has come back a lot over the last 10 years. But at what cost? So we have really substituted one new problem for all these old problems. And that problem was what I tried to outline in my talk. We've got interest rates at a low level where monetary policy doesn't work. And in huge segments of the global economy, Europe and Japan, we actually don't know where we are going from here because we are stuck in low negative interest rate territory and the economies are really not recovering. So Christine Lagarde is going to have the problem of her lifetime to solve, and she'll need all her political skills to handle that. Japan has been struggling along for several years, keeping economic growth at a slightly positive level. Inflation has been also slightly positive, but in the meantime accumulating more and more and more debt. So this process of accumulation of debt as a way of has simply become the status quo. And obviously, debt cannot rise forever. So that's an obvious statement. And I think that as a result of that, at some point there will be some type of reckoning. Now, I hesitate to say that it will end with a bang rather than a whimper. But this is the problem that we have to face. I suspect that the solution will need to be multi-pronged, and it will involve some degree of wealth transfer between generations as well as redistribution in order to turn these economies back around. But this is a problem for the next 20 or 30 years.
That leads me to the second question. The audience also had this question to say, if we don't see monetary policy as being very effective, and that's I think very much the commentary in India today as well. What is the alternative? So you talked about a little bit in your presentation, but is there an alternative and what do you think would generally happen towards stimulating monetary?
I may disagree slightly with the premise of the question. So while monetary policy certainly has reached its limits, I'm not one of those that thinks that lowering interest rates and quantitative easing was not successful. Because we don't know the counterfact. How would the world have behaved without those features? I suspect that things would have been far worse, all right? But having said that, I agree that interest rates are so low and balance sheets are already quite high. So in fact, monetary policy cannot be the first foot forward for the next crisis. I think it has to be, or the next big downturn. I think there has to be a very large fiscal element. And fiscal easing is already being talked about in most parts of the world and accepted also in most parts of the world as being the correct tactical tool. The problem with fiscal easing is that it has a habit of sticking around past the point where it's necessary, and it becomes a habit, spending more than you have, especially when you can accumulate debt at low yields. So the danger that one has to watch out for is that this will become kind of a tool for normal times, not just for cyclical recoveries.
And back fiscal discipline becomes much more difficult. So there's another line of inquiry and kind of leads to one of the questions that I had. You talked about the relative attractiveness of emerging markets, particularly India, in the global economy in terms of the rates, particularly at this point in time, and which is what we also see. So from a domestic versus international rate arbitrage perspective, there is definitely incentive to look at offshore markets, especially if the tenor of debt is longer. And from an investor's perspective, this seems to make sense as well. But what is your sense in terms of the risks to this? And I'll ask this in a couple of different ways. You talked about trade wars. What is your sense of what is the policy direction for US rates next year? Do you think there are risks to the US growth in terms of slowdown, which you anticipate? And in that context, how would investors look at the relative attractiveness of global markets, particularly India, because that concerns a lot of us here? Do you think they would overweight some of the risk factors that we've seen more recently, or continue to be interested in looking at India as an investment destination?
I'll break it down. That's a long and complicated question. I'll try my best.
Sorry about that.
First of all, if the US sneezes, India catches cold. So that's certainly the case. I think that the Indian stock market, as well as the Indian rupee and bond market yields, will all be affected if the S&P 500 has a significant downturn because of a turn down in the US economy. Goes without saying. That's true despite the fact that we don't actually have a huge amount of direct foreign portfolio flows, although there are some, particularly in the equity market. I think a lot more of that transmission is actually macro in nature and comes from the potential for cyclical slowdown in India alongside an overall diminishing of risk appetite. So that's something that I think cannot go away because, India doesn't have a huge amount of dependence on foreign investors today. So if you look at the dollar bond market, the domestic rupee-denominated bond market, the foreign participation in the Indian market is quite low. So I don't think that it will be through portfolio flows. One can make the case that Indian issuers can and should take advantage of low yields abroad to borrow. I think that they should be careful about the percentage of their debt that they actually raise in that way, and as well as the maturity structure of the debt. It's always better to raise long-dated bonds and have multiple options so that you're not entirely dependent upon foreign investors. Countries like Mexico and Indonesia that have become substantially dependent on foreign investment for their domestic bond markets have found that it has led to a lot of volatility in the currency because when foreign investors buy the domestic bond market, they often don't hedge the currency, and when they leave the bond market, they also leave the currency market and demand dollars on the way out. So the currency tends to weaken whenever you get these outflows. You really want to avoid those outflows being very large. Otherwise, the RBI at the wrong moments, when they actually want to be able to tighten policy, may be forced to do the opposite. So I think that that's the kind of double-edged sword for domestic issuers as well as policymakers in terms of deciding how much to encourage foreign flows. There are a number of mechanisms that countries have used to reduce that volatility, and I think that India has all of those at its disposal. The Indian authorities are extremely well aware of the issue here, and I think that they do not need any advice from me or anybody else. They are very well aware of what those vulnerabilities are. In a sense, though, India is probably the dominant power, growing power of the next 50 years. As such, we need capital to grow. So I think we have to abstract and pull away from the tactical issues of what happens when you do that to the longer term issues, of needing the capital, using it wisely, and as long as we establish a set of rules and adhere to those rules in terms of how capital is treated, how contracts are treated, investors will look through the volatility that comes with day-to-day movements in interest rates, currencies, and equities, and will stick with us.
Follow on to that, in terms of some of the events that we've seen in India over the last few months, specifically seeing larger, well-rated institutions moving to default very quickly. A sense that there may have been a failure of market infrastructure in terms of the institutions which should have provided oversight, information asymmetry, and many other challenges. These may not be unique to the Indian markets. And just trying to get a sense of, do you think investors worry excessively about this, or is your sense that people understand that this is part of an economy going through a process of maturing, bond markets maturing, and these are likely to be speed bumps, even if it seems fairly significant as a crisis and a challenge to a lot of us, but in the history of markets, this could be viewed as a speed bump. Given your experience, what is your sense of how people are looking at it?
Yeah, I think that one of the reasons why emerging market allocations in global portfolios is low relative to the size of GDP and the promise of growth that these economies offer is a certain degree of conservatism around the questions of can I get my money out, will there be issues with the promises that have been made, will there be good enough governance, that I can rely upon the rules as they are written, and how well does the country respond when something does go wrong. So I think that all of those are very relevant considerations. When you said worry excessively, what is an excessive level of worry? So I think that to the extent that a idiosyncratic incident indeed remains an idiosyncratic incident, and not only that, but it draws the appropriate regulatory response in terms of fixing and curing the situation, I think that investors will move on. And there is clearly a dearth of good opportunities around the world. There is a reach for yield. I can tell you right now that if the Indian sovereign decided to issue in dollar markets, there would be tremendous demand. I think if the Indian bond market were included in local indexes, there would be tremendous demand. There's been over 150, maybe $200 billion of foreign capital has flowed into Chinese domestic bond markets since China became included in global bond indices. That process is continuing for about 20 months, and there will be ramp up. India could do the same. I think the question for India should be, do we want that? And are we ready for all of the different implications of that? I think that, while we do that, I think the question here is also one of making sure that idiosyncratic incidents, the kind that you alluded to, remain that way.
So in other words, what you're saying is that you will also assess the risk of contagion and evaluate policy decisions, regulatory action in that context. To say, is enough being done to limit the contagion effect of
I think that, rather than contagion, I'd use the word, is it systemic? So is a particular failure or a particular incident an indication of what one should expect to see again and again? Or is it just something that occurred once, and not only is it not something that would constantly repeat, but it's actually something that will then get fixed so that that particular thing won't happen again. And that's actually what's required.
Talked a little bit about the negative interest rates in some of the economies. So your thoughts on what do you think this is sustainable? Clearly doesn't seem to be. And what do you think could be policy measures or actions that they take to reverse some of that or put that back on track?
I think that structural reform is the only way out. In the case of Europe, I think learning to get along and completing the union. So having a monetary union without the completion of the fiscal compact and structurally a common approach those have been the hurdles. So in the absence of those, Europe remains an incomplete, although nobly intentioned project. And I think that if we don't complete that project, we would probably continue to bounce along at below potential growth and will require extraordinary measures from time to time, as have already been done. And I think interest rates and inflation will remain low in that context as well.
You had a comment, this is one of the questions from the audience. You had a comment on what lower tax rates do to the perception of interest rates. And I think we have a couple of follow-up questions there. One to say, have you seen lower tax rates enabling higher GDP? So is that really going to help?
Have you seen lower tax rates do what?
Enabling higher GDP growth.
Enabling higher GDP
yeah.
growth.
So I guess that's one of the tools that the government brought in, at least to improve sentiment here. So I think that's one of the questions. And also to say, does it change how companies view their ability to take on leverage, which I'm not clear about, but possibly the first one.
Yeah, it's lower tax rates will clearly boost GDP at least once. Now, whether that's a good idea or not depends on whether the appropriate level of taxation was present in the first place. So the problem here is that as inequality increases in society, the government needs more, not less revenues to try to level the playing field. You can do that with lower tax. You can temporarily raise the economy with lower tax rates, but if that results in an overall drop in revenue, and I'm not one of these people that thinks that you can actually lower tax rates and revenues will increase. There's no magic here. The lower tax rates, your revenues will decrease. So you have to make that up with growth. It's really hard to make the argument that that happens. So I think we're seeing inequality is I think one of the biggest problems of our generation. It cuts across all the countries, and I think it's a problem that has to be solved with a multi-pronged approach. The government can't just tax its way to equality, but it also needs tax as one of the tools to use. That points in the opposite direction to a tax cut. I think without that progressive element that lowers the levels of inequality, you get political turmoil that may ultimately hurt growth more. And I think that's the trade-off. Beyond the fairness and the human decency elements of wanting to have a more fair society. So I think the social compact depends very much on everyone sharing in the gains that are being brought about by productivity gains. If those productivity gains are largely tied to automation and technology, and if the owners of these robots, if you like, are the ones that are getting all of the spoils, how do we take those spoils and distribute them more broadly? Who owns the ideas? So our whole sort of material world, kind of the world of capitalism and markets, is based on the idea of property ownership coming from Europe, from the medieval times. That property ownership concept, when applied to intellectual property, says one person can have an idea for a robot, and then they own all of the spoils that come from that robot replacing every human being on the planet. But an idea, unlike property, can be copied. And if you have an idea and you share it with me, I can have the benefit of that same idea. So there are two ways of thinking about it, and I think that over time some compromise will have to be found so that all of humanity can benefit from the benefits of automation. We are producing enough to feed the planet, to clothe the planet, to house the planet, provided we are able to create a system that allows that to happen.
Thank you very much. I think we have possibly absolutely run out of time. I can see the questions still streaming in, and I'm sure there's a lot more that I and everybody else in the audience would love to ask, but thank you so much.
Thank you. Thanks for having me.